Blockchain technologies like Bitcoin and Ethereum have not yet impacted the lives of most consumers. The theoretical breakthroughs that blockchain technology enables will eventually happen. I will be able to pay 1 cent to a knowledge worker in Africa without having to pay a 5-cent transaction fee like I do today. My servers will be able to pay other servers for small compute jobs. We will have decentralized versions of sharing economy systems like Airbnb or Uber. But first, there are many infrastructure and policy issues to sort through. The technology is not quite there yet, and people running even simple mining operations are threatened by our current legal framework. Coin Center is an organization dedicated to education of policymakers and media about blockchain technology. Coin Center also is an advocate for certain policy changes. Peter van Valkenburgh directs research at Coin Center, and he joins the show to talk about the issues that stand in the way of that utopian dream of micropayments and IoT and other blockchain miracles that we will eventually have. I enjoyed this episode a lot. I hope you do too. Life is too short to have a job that you don't enjoy. If you don't like your job, go to hired.com/SEDaily. Hired makes finding a new job enjoyable. And Hired will connect you with a talent advocate that will walk you through the process of finding a better job. It's like a personal concierge for finding a job. Maybe you want more flexible hours or more money or remote work. Maybe you want to work at Facebook or Uber or Stripe or some of the other top companies that are desperately looking for engineers on Hired. You deserve a job that you enjoy because you're someone who spends their spare time listening to a software engineering podcast. Clearly, you're passionate about software, so it's definitely possible to find a job that you enjoy. Check out hired.com/SEDaily to get a special offer for Software Engineering Daily listeners. A $1,000 signing bonus from Hired when you find that great job that gives you respect and salary that you deserve as a great engineer. I love Hired because it puts more power in the hands of engineers. Go to hired.com/SEDaily to get advantage of that special offer. And thanks to Hired for being a continued long-time sponsor of Software Engineering Daily. Peter van Valkenburgh is the Director of Research at Coin Center. Peter, welcome to Software Engineering Daily.
Thanks for having me, Jeffrey.
Today we're going to talk about blockchain technology and policy and how that exists today. But I want to start at the high-level, exciting, futuristic speculation stuff because I think that will better motivate a discussion around policy and engineering. And specifically when I think about the exciting futuristic speculation, I think about the micropayments. Like, I should be able to pay someone in India the equivalent of 1 penny for a transaction using the blockchain. So when we think about that idea of paying somebody across the world 1 penny, or we think about things like microtransactions between servers, what are the barriers to those that exist today? Are they mostly technical or are they at all regulatory?
Actually, finding a single scapegoat, either technical or regulatory, is hard. But what we can talk about is your existing options. And your existing options are the, what I might call the legacy payment rails. And that's going to look like either credit card transactions or something more heavy duty like a bank transfer, or possibly one of these newer systems that is a centralized payment system where you can pay other people who are users of the same system. And of course, the good examples of those are things like Venmo or PayPal or things like that. So then to talk about, are any of those good for microtransactions? The centralized systems are probably good for microtransactions. What did I buy? I bought something that was $2 with PayPal, and there was no fee because they took it from my bank account, and they were paying someone else on PayPal. I can't remember what it was, but that worked, although that's still bigger than what you were suggesting, which was a couple cents. And then the other problem with something like PayPal or Venmo is you can only pay other people who use PayPal or Venmo. They have to sign up, they have to connect their bank account to that and fund that. And the funding transaction to actually set that all up is a transaction that's going to happen on the legacy systems, whether a credit card or, as I said, a heavy-duty type thing like a bank transfer or a wire transfer. So what we really want is an open, interoperable system that just makes payments as simple as sending packets of data across the internet, right? I mean, from a technical engineering standpoint, from the standpoint of, I'm assuming, your audience, that's just what makes sense, and it seems silly that we still don't have that.
Just a ledger.
Right, a ledger, just a way to move value between peers on a network without having to worry about some sort of centralized intermediary, and also without having to worry about prohibitive fees that make a small transaction like 5 seconds, like paying for time on a server or paying in order to read a little bit of content or listen to a little bit of a podcast, makes those kinds of payments infeasible. And the reason for that is any credit card transaction, and most of us who've bought stuff online, we always use credit cards generally. Any credit card transaction is going to necessarily carry with it a minimum fee. And the way the fee structures, they're different whether it's Visa or MasterCard, depending on the credit card network. But the way the fee structures usually work, there's a flat fee, which is somewhere between 5 cents and 15 cents, sometimes even more. And then there's a marginal fee that's related to the size of the transaction. But that flat fee there is the thing that's deadly to microtransactions for the internet, or really microtransactions generally, because if what you're buying basically is something that's worth about half a penny to you, like what's it worth to read just the lead paragraph of a Wall Street Journal article? It's not much. Nothing against the Wall Street Journal, but honestly, it also would be cool if we could monetize that, because the way the Wall Street Journal gets by is by monetizing their content, but they can only do it in a big lump sum. You sign up for a Wall Street Journal subscription and you get access to all of their articles. You can't just read a little bit. You can't just read a lead paragraph. And part of that's because they want to get you, and they want to have you pay for more than you're actually consuming and gain the upside of that basically in the transaction. But also part of it's because if there's a 15-cent flat fee, they'd never be able to charge just for reading the lead paragraph in an article, because the fee to make that transaction go through would be greater than the amount they were receiving in payment for reading that article.
Yeah, and so that's definitely a good example. There's also, I really think about the example of there's somebody in a place like India or Africa that has knowledge worker ability, and I should be able to pay them a small amount to do some sort of creative knowledge work. This type of knowledge work that we outsource to individual contractors. This stuff is going to increase as time goes on, and we need less friction so that there can be more global transactions. We can have a more mutually interdependent financial system, a commerce system. And if we have these balkanized payment systems where there are high transaction fees for even micro transactions,
right,
then even if they're warranted, or if they're in some sense the money is going towards preventing fraud, they're still onerous charges.
Well, and that actually gets back to your original question, which I sort of weaseled away from, which was is it either regulatory costs or are these actual technical costs? There is definitely a regulatory element. So all of these financial institutions that your payment goes through when you're using a credit card, for example. So a lot of people don't realize how credit cards actually work. They just take them for granted. You were issued your credit card by an issuing bank. So that's the first party that the transaction actually runs through. And then the issuing bank has an agreement with the credit card operator, network operator, or sometimes they're just called the switch. And that's Visa, that's MasterCard. And then the third party here, and there's always at least three parties in these online transactions, is the bank of the recipient, who is, that bank is a merchant processor bank for the credit card as well, or just another, card issuing bank if you're paying another individual, basically. But it's going to be a merchant processor in cases where you're actually paying for a service, for example. So, which with each of those three parties, and especially the two banking parties, you're talking about pretty heavy-duty regulatory compliance burdens. And some of the costs of complying with, say, anti-money laundering requirements here in the U.S. Under the Bank Secrecy Act, for example, which has to do with, keeping real close track of who all your customers are, where they're living, what their identifying information is, and then also monitoring some of their transactions and reporting suspicious ones or particularly large ones to the federal authorities. Something we might call financial surveillance, if we wanted to be less charitable than the otherwise seemingly innocuous AML KYC compliance. That has costs. And then additionally, also, credit cards pay their users to use them. So like when you get airline miles or rewards points from your credit card, some of the fees that you're paying per transaction are going actually to provide you those rewards, which is a strange system, but a system that actually gets a lot of people to, switch from one card to another. So it's sort of a marketing tactic because you want that first-class trip to India for vacation or something.
Although that is an example of the type of inefficiency, the type of tax that we're paying at a core fundamental level with the types of systems that we have. I think there are also other taxes.
You're right.
Yeah. There are also other taxes that we pay in terms of the fact that these older systems are running on this horrific infrastructure, and there's all kinds of inefficiencies that are gonna have all kinds of leakages because of that, and that's why it's having some greenfield systems might be good, even though I hear that a lot of these greenfield systems are eventually kind of being built on this old aging infrastructure with FTP stuff between banks, and I want to get into that. Okay, so another like futuristic high level thing is this dream that we have about like IoT stuff. Like we have this dream of being able to walk into Starbucks and you get a cup of coffee and you're charged for it without having to do anything. You don't have to interact with a barista or anything. You just get the coffee, and my phone just communicates to the blockchain. What is at this intersection of IoT and cryptocurrencies? Is this stuff where we can start to be thinking about policy?
Sure, absolutely. Yeah, so in order to get there, we've kind of skipped straight from legacy payments to blockchain, and the simple what is Bitcoin or what is cryptocurrency answer to build that bridge is, all right, so you had three different ledgers with the two banks and the credit card network, and all of them keeping track of user balances or partner balances. Consolidate all those ledgers into one, call it a blockchain. It's a data structure that exists redundantly across multiple computers connected to the network, and those multiple computers, which are actually often the computers of users who just want to pay other users, those multiple computers hopefully do some sort of trusted multi-party calculation of some sort that results in consensus or agreement from the nodes that the current state of the ledger of who has paid who, which user has paid who, is valid and non-fraudulent. No one's tried to pay somebody twice with the same funds. In other words, duplicated or counterfeited currency. And that is the magical invention that is Bitcoin, and it really is a computer science breakthrough. It uses all sorts of long-standing and well-understood components like peer-to-peer networking technology, like hash functions, SHA-256, and elliptical curves, but it combines them in a novel way that creates this distributed computing system that is able to create an authoritative ledger of all transactions. So then to get into IoT, so that solves payments potentially, and I'm not suggesting that we're there right now with the Bitcoin network, because actually with the block size limit as it is right now, you might expect to pay 15 cents per transaction using Bitcoin too, which is interesting. We can talk about that more later if it's something you think your readers would be interested in and what the block size debate is. But it's actually kind of an arbitrary cap in many ways, and not something we would reasonably expect to persist. Maybe in Bitcoin it'll persist, maybe not in other systems. So there probably is an answer here for micropayments, and it also might involve new technologies like the Lightning Network, which we can discuss as well. But your question was about IoT, and the simple intuition here is, okay, if we have an authoritative list of transactions that are effectively time-stamped relative to other transactions, so they're bundled in an order, and the order is something everyone agrees on, then we kind of have the state of a very limited computer, a global computer of a sort. We have an order of events that alter the state of that ledger, and in many ways, that's a compute function. Now, we could do more than just keep track of scarce balances with this, with this stately data structure. We could notify. We could notice and allow people to announce when an identity assigned to a device has either been attested to by an individual. So it's like, this is my laptop. I'm signing. This device will identify itself as my laptop because I'm signing a transaction statement with elliptical curve type signature, or this is my cell phone. Starbucks would say this is our POS, our payment system, and these devices can then have an open ledger of device identity, which is basically one half of what you need in order to have that ideal world with IoT, where you just walk into a building that has things that you want, you take the things that you want, and there's this handshake behind the scenes that identifies who did the taking, who did the selling, and then actually furthers the payment as well. So really seamless, utopian, techno-utopian commerce, because you have identity for devices that can be trusted and is interoperable and open, and because all that data resides on this identity type blockchain, and you have payments between those identified devices or parties because you have a blockchain for transactions and micropayments. And they might be on the same blockchain, they might be on different blockchains. There's all kinds of ways you could architect the system. The bottom line is you get this consensus over a data structure and a stateful data structure. So you could do identity, you could do transactions, you could do all kinds of computation.
Yeah, and my sense is that where we are today, we'll get into the regulatory stuff, but my sense is that today the big barriers to this type of utopia becoming a reality are technical barriers, because what was outlined in the Bitcoin paper and what has been done in the implementation since then, there's a big gulf between the big Bitcoin dream that was outlined in that paper, that what this theoretically could become, and the infrastructure that we've built. Because when you smash all these computer science concepts together that Satoshi did, it's like, oh my goodness, we need to build a lot of infrastructure to make this a possibility. And that's why there's such a misunderstanding about like the hype cycle around Bitcoin, where people are saying, oh, there's no killer app for Bitcoin. It's like, okay, where's the why would you build why would you build an internet that looks anything like the internet we have today if we had just dial-up? It would look totally different. And that's where we are today with Bitcoin, is we're at dial-up stage.
I think that's right, yeah. Mark Andreessen, the venture capitalist at Andreessen Horowitz, wrote an article maybe 3 years ago now, I think, saying that Bitcoin looks like the internet in 1996. And that was 3 years ago, which means we should be at internet, 99 or 2000 by now. And I don't think we're seeing that with Bitcoin. I don't think we're seeing that means Google should be emerging now. That means real killer apps for the internet should be emerging right now. And we're not seeing killer apps emerging for Bitcoin. So I think he optimistically miscalculated, and I think he's brilliant. I don't mean to, future prediction is hard. But
is there any chance that Google?
Well, I was going to say
Google is.
I was just going to say that I think the real date is probably closer to maybe 1986. Like we're at the beginnings of widespread use of TCP/IP. We're not at the beginnings of HTML and the higher level protocols that enabled the highly useful web that we have today on top of the internet.
What about that company 21? I mean, that's a company that Andreessen has invested in. I think it was an ex A16Z partner that started this company 21 Co.
That's Balaji Srinivasan.
Yeah, and this is like a massively they've raised a ton of money, and they're building some Bitcoin technologies. I mean, maybe that's the Google of Bitcoin, right?
It could be, and based on the beginning of our conversation today, they're aiming in the right direction. So what they're trying to do is really nail device payments, so machine-to-machine payments using these systems. Their first, I hesitate to call it a product because it was sort of a dev kit, was this 21 Bitcoin computer, which was basically a Bitcoin full node with the capability of mining also, and basically an SDK that would help you as a developer write any number of programs that could utilize Bitcoin for payments, and that could be build an API such that whenever someone pays you, your Twitter account will tweet hello world or something like that. So connecting any number of digital goods that you might want to sell, including, say, your influence, if we're talking about pay per tweets, to a payment system and an electronic marketplace that was liquid, that can actually handle that, unlike the existing credit card system, which of course cannot handle that.
So, we've been skating around a lot of different topics around Bitcoin, but I want to get into the Coin Center. So you work for the Coin Center. What is the Coin Center?
Sure. A small technical note: we try and drop the like Facebook. We're not the. So Coin Center, and we also put a space between coin and center. It's so funny how in the internet there's all these strange norms about intercaps and unifying words and things like this. But anyway, I'm digressing horribly. Coin Center is a nonprofit research and advocacy center. And we're based here in Washington, D.C., where I'm recording from right now. And we've been set up for one very specific purpose, and that is to guarantee that open blockchain networks, so things like Bitcoin, things like Ethereum, that open blockchain networks get the same benefit from a policy and governance standpoint that the early internet got. And the early internet benefited tremendously from basically a hands-off approach that was probably best pushed for and evidenced by the Clinton administration's principles for the information superhighway, which there were a number of principles there. I won't go through all of them, but it's things like the private sector should lead. Where regulation is necessary, it should be light touch and activities-based, not technologies-based. So there were a lot of things that came together on the regulatory side that I think helped hasten the development of the internet. It could have been a lot slower and a lot worse if policymakers had not been well educated on these topics. I mean, people make fun of Al Gore, but he was actually pretty well educated on these topics. Had also that they well understood the upsides of those new technologies and maybe only focused on the downsides, and then had not sort of cleared the path for free and using those technologies by either subtly adjusting existing laws or by refraining from things that would have encumbered people's abilities to innovate using the technologies. So the same issues that the internet had, open blockchain networks have, and they might even have it worse because they deal quite often and actually at a fundamental level with a scarce token is money. And whenever money enters the picture, it's kind of the original sin. It changes some of the risk and benefit calculations that someone like a policymaker might do. We have a really good tradition of protecting speech and people's abilities to speak in the U.S., and we also have a pretty good tradition of protecting their privacy. And Snowden leaks aside, we've got at least some expectation of privacy over our personal data. It's interesting with money. Money is speech in a way, but do you have an absolute right to always pay people? Actually, not. You right now cannot pay someone in Iran, for example. If you did, you'd be in violation of OFAC sanction laws, and the penalties could actually be quite strict. And then from a privacy standpoint, we actually have no right to privacy over our financial data. None whatsoever, basically. Assuming we use any financial intermediary like a bank or a credit card company, at that moment we lose any right to the privacy of those transactions. And that's why this financial surveillance regime that I was describing is so robust, basically. Any transaction you make over $10,000 will be reported to FinCEN, unless you're doing it through an institution that is rogue, which I wouldn't recommend.
So Coin Center is focused on education. You want to educate policymakers. You want to educate the media. You also have an element of advocacy. So you do take certain stances on areas of the blockchain. Where do you stand on financial surveillance? Yeah.
So it's a good question. We haven't been sort of a firebrand in that area. primarily because there are other issues that are of prime importance. So just the ability of people to even start a business in this space is one of them. But, I'll say this. So we generally don't regulate individuals. OFAC is the exception there from a financial privacy standpoint. It's not even privacy. It just means you can't pay people in Iran. But from a privacy standpoint, we generally regulate institutions, not individuals. So there's a number of companies out there, Bank of America, et cetera, who all have to register with FinCEN as a bank or as a money services business. So PayPal is a money services business. Airbnb is probably, I'm quite certain, is a money services business because they move money from their rentors to their rentees. And when you register, you also need to track your users and report their transactions if they're either suspicious or over $10,000, as I said. And you need to do really good know your customer. So you need to find out a certain amount of information about them. And there's no way around that. Now, there's an open question, or there was an open question, rather, when Bitcoin first emerged. Is a company that does something with Bitcoin, and that something could be a variety of things, like hold other people's Bitcoins. It could be we mine Bitcoin transactions. It could be we build software that help people hold their own Bitcoins. So like a blockchain.info, which creates a wallet product, basically, that allows people to hold their own coins. Are any of those companies the kinds of financial institutions that under the Bank Secrecy Act, FinCEN is allowed to mandate that they register and do that kind of anti-money laundering financial surveillance regulation on those companies? And FinCEN settled that in 2013 with what was called the virtual currency guidance, and said basically if you're an exchange or a hosted wallet provider, so like a Coinbase or a Zappo or a Circle, then you are a financial institution. And then in a series of other opinions, because that original guidance was somewhat vague in some areas, they pretty well clarified that miners, for example, do not need to register. They are not regulated financial institutions in that sense for surveillance purposes. And neither are software producers who merely make a Bitcoin wallet. Now, where we would take a very strong stand with regard to financial surveillance is that current, we can call it a compromise, that current compromise needs to stand. And we cannot move in the direction of mandating that people who just design software that other people use build sort of backdoors into that software that will monitor those users' activities. So blockchain.info, as a provider of hold your own Bitcoin software wallets, should not be forced to spy on the people who use their software. And a miner, so someone who mines transactions, validates transactions on any of these open blockchain networks as an infrastructure provider, despite the fact that they may have some visibility into these networks, should not be mandated to do that kind of surveillance either. We want to keep the set of surveilled entities to those who are traditionally regulated by these laws, and that is people who hold other people's money for them. Banks, PayPal, and Coinbase and Zappo and Circle, but not Bitfury, but not blockchain.info.
As an engineer, I'm focused on the functionality of my application. Can users upload cat photos to my app? Can users see each other's cat photos that are being uploaded? I am more focused on building new features than things like security or error-free code. And now I don't have to choose between new features and things like security. Codescope JAX helps JavaScript developers secure their source code as they build applications. JAX analyzes your GitHub repository as you are building an application, and it finds areas of your code that can be improved, whether that is a security issue or some kind of error. Go to codescope.com/SEDaily today to get free usage of Codescope JAX. That's CODISCOPE.com/SEDaily. You can get free usage of JAX on an unlimited number of repositories. My JavaScript applications are usually throwing off all kinds of errors that I keep telling myself I will fix, but I never get around to fixing them. There are frameworks and tools that are changing so quickly. I don't know what security risks I might be ignoring in my application. At codescope.com/SEDaily, you can try out Codescope JAX and it will teach you to write better JavaScript. Thanks to Codescope for being a new sponsor of Software Engineering Daily. So I want to vacillate back to the engineering side of things. We'll get back to policy. The blockchains, or the block size that you mentioned earlier. So what is the debate around block size? Give some more color on how engineering of Bitcoin is going today. I'm starting to hear this basically that if you're cutting edge, if you're a liberal blockchainist, you hack on Ethereum, and if you're a conservative blockchainist, you hack on Bitcoin, because Bitcoin sticks more to the things that are outlined in the Bitcoin paper, like it was handed down to Moses, and Ethereum is a little more aggressive in how they're changing things. Just give me a snapshot of the engineering landscape.
Sure. I think you're right that there does almost appear to be an ideological difference between Ethereum and Bitcoin. And you could say that is a political one, like liberal and conservative, or just a general approach to how things should be built. And there are positives and negatives to say about either side in that debate. You could call the Ethereum people naive and too risk-seeking, basically, because they'll build things rapidly, iterate rapidly, and those things often break, as in, say, the case of the DAO, which was the largest crowdfund in history and also one of the greatest failures to do a successful crowdfund in history. But you could say about the Bitcoin people, as you were hinting, that this is a dogmatism that is not based on reason, but based on the fact that it was handed down from Moses Satoshi. But you could also say positive things about each. So Ethereum developers tend to seem less encumbered by a pre-existing bias as to what the system should look like, what it should accomplish, and seem perhaps more focused on just building technology that works to do any number of things, not just the one thing you liked, which was, say, intermediary-less payments. But then you could say positive things about the Bitcoin developers as well. You could say something like, well, they understand that the foundation of any trusted system needs to be simple, because as it becomes more complex, the attack surface broadens, it becomes more vulnerable, and the whole thing could crumble. And take the internet, for example, TCP/IP is very simple, and it's a great base layer to build more interesting layers on top of, whether it's HTML, whether it's SSL, whether it's anything that you want to describe the packets that are moving over the relatively purpose agnostic and secure lower layer. So that's one way I would characterize the two, and I love both, quite frankly. And then you asked about the block size, which is sort of evidence of the deep conservatism, as you suggested, of the Bitcoin developers. So the core software that Bitcoin is powered by has a number of consensus rules. And consensus rules are everything from no transaction can reference an already spent input transaction. In other words, you can't try and spend the same Bitcoins twice. That would be fraud and counterfeiting. Another consensus rule, however, is that new blocks, so new bundles of transactions that have occurred roughly over the last 10 or so minutes, cannot exceed a megabyte in size. And you get down to the technical specifics. That means that given the size of any individual transaction, the maximum number of transactions you can have per second on average ends up being around 7 if you're liberal in your calculations. And actually, in practice, we find that the network gets very creaky around 2 or 3 transactions per second, which, if you think about what Visa advertises about their credit card authorizations, and I would quibble that Visa's just doing authorizations, they're not doing settlement, but they still, do these authorizations. Visa does on the order of 40,000, 50,000 per second, I think, and I've heard that they've built data center capacity to handle as much as 200,000 or 500,000. Who knows? It's orders of magnitude larger. So it is a problem that the block has this 1 megabyte cap if you really want Bitcoin transactions, as in, I sign a transaction message with my private key and send that transaction basically, or enumerate in that transaction a recipient based on their Bitcoin address and hope that that goes to the blockchain and makes it into the ledger. If you want to do global payments in that setup using Bitcoin, you're going to hit some real limits as far as throughput. And the main one,
so the main one
being
sorry, so
that
just to clarify, so you're saying that the blockchain, the global blockchain, can accept 2 to 7 transactions per second.
The Bitcoin blockchain, yeah. And the reason for that limitation, to be also very clear, is an arbitrary variable in the Bitcoin software. It's not necessarily network latency or any number of other real technical problems. It's actually a line of code in the Bitcoin core client that says that blocks cannot be larger than a megabyte. And if your Bitcoin client recognizes blocks that are larger than a megabyte, your data will be ignored from the consensus as prima facie invalid.
So, and in a sense, I guess is the reason that is actually somewhat defensible, somewhat well-reasoned, is you could say, well, we want at the most fundamental level of the Bitcoin blockchain there to be very low constraints on the bandwidth that you need, and then we could build these things on top of it that, based on the trust that develops at the lower layer, or based on other systems that you want to build on top of that lower layer, you can build the speed, and that's what Lightning networks are.
Yes, yeah. So that's exactly right. That's the argument that those who are vehemently against changing that arbitrary variable to be a larger cap or removing a cap altogether. That's the argument that those who are against that change make, which is we want this thing to be a minimum viable product basically for doing settlement. And then you could basically build higher level networks that batch a bunch of transactions into 1 or 2 transactions. And those 1 or 2 transactions are the ones that end up in the blockchain. And
these are like automated clearinghouses.
Yeah, kind of like automated clearinghouses, but ideally the automated clearinghouses also would be basically trust minimized so that you don't reinvent the correspondent banking system. You basically use cryptography to bundle transaction messages in a way that doesn't rely on putting the faith in any intermediary parties. And the Lightning Network's pretty complex, so it's probably beyond the scope of a shorter podcast. But it generally achieves that in theory, and we're seeing actual prototypes begin to emerge now that would basically accomplish that.
Sure. No, we did a show about a year ago with Rusty Russell.
Oh, awesome.
He works at Blockstream, I think, and that was all about Lightning networks. And this is Rusty Russell, I think, was one of the early contributors to Linux. I think he was like number 2 to Linus Torvalds for a while. And that gives you some perspective in terms of the talent that is working on these things.
Yeah. Yeah, and this concern about big blocks, which you hinted at, is very real too. It's not just that the network would get slow because of the limitations of bandwidth in a peer-to-peer network. It's also that with limitations on bandwidth, you would create some perverse incentives that could defeat the main goals of the Bitcoin project. And those perverse incentives basically look like, if you're a miner, you get an advantage generally of being the first to receive a message that another miner has completed a block. Because if that block is valid and added to the chain and you want to build the next block on top of it, the faster you get that previous block, which is a necessary input to your next block, the more likely you'll hit upon the next block before any of your competitors. So if the blocks are big and you actually have real latency, there becomes a real strong incentive for miners to geographically co-locate. And they'll probably all geographically locate in an area with very affordable power or electricity, because these mining rigs are electrically intensive, which means you could very realistically, if the block size increased, have a greater chance of all the miners ending up in western China near a hydroelectric dam that was built for a town that never materialized, for example, which is actually quite common. Or maybe all in Iceland, or maybe all in the Pacific Northwest of America, although that seems less likely given the regulatory risks you'd be potentially assuming. But no matter what, if all the miners end up in one small area, how trust minimized is that system at that point. Because if all the miners act together in concert for a prolonged period of time, they can do a lot of harm, basically. They can effectively just block or selectively censor people from transacting using the network if they don't like their politics or their history or any number of other things about them. Or they could potentially rearrange the chain starting from the time that they assumed that majority power up till the present, potentially, fooling people into thinking that they'd paid and then having them pay again.
Okay, so now we have dove a little into the technical aspects. I would love to hear more about how Ethereum technically compares to Bitcoin, but I want to bounce back to the policy discussion. So one thing the Coin Center is concerned about is consumer protection. So consumers engage with an entity like Coinbase, and Coinbase functions something like a bank. But the difference from the consumer protection point of view is that the policymakers need to understand how to enact laws that protect consumers without infringing on the technological process, the technological progress of Bitcoin. So why is this a tricky line to walk? Why is it tricky for policymakers to figure out a way to effectively regulate a organization like a Coinbase while not infringing on the technological progress that might occur?
So with consumer protection and with the U.S. specifically as our regulatory landscape, we're already at a disadvantage compared to, say, the European Union or other foreign states. And that's because in the U.S., consumer protection for money transmitters, that is to say people who hold and then move people's money who are not banks, those are money transmitters. Consumer protection for money transmitters is done historically, and somewhat by accident perhaps, at the state level. So Alabama does consumer protection regulation. New York does consumer protection regulation. And the federal government actually doesn't do too much consumer protection regulation. They don't license and permit businesses to exist. They wait for the states to do that and then maybe enforce some other consumer protection concerns through individual actions against bad actors. So what the states are doing, what every one of the 47 states and territories that regulate money transmission for consumer protection purposes are doing, is basically saying no one's allowed to do this unless they first get in touch with us and then get a license to do this with customers in this state. And that doesn't mean that if you're a business in New York, you only need to worry about New York as far as getting a license from the regulator in that state. If you are a business in New York that creates a Bitcoin service like, like Coinbase, for example, you're going to need a license in every U.S. state where you have customers. And because the internet usually is, well, global, you're going to have customers from day one, potentially anywhere, and probably in many states, and hopefully, if you're successful, all of the states. So that means you're going to have to actually get permission from a regulator in every one of the 47 states and territories that regulates this. And getting permission from them is not easy. It's especially not easy when you're doing something that's new because, regulators are smart people, but they're smart people who have focused their whole lives on legacy technologies and guaranteeing consumer protection for those technologies. So the companies that a money transmission regulator in Iowa are used to dealing with are Western Union, the original telecommunications provider, or maybe at the most exotic, PayPal, which emerged about, 10, 15 years ago for them. You're not up to speed on Bitcoin, and you have no idea what these technologies even are, virtual currencies, or what necessarily you're supposed to require from these companies that are suddenly asking you to give them a license to have customers in your state. And on top of that, your laws. So as a regulator, you have obligations, basically, that are set down in legislation. You need to protect consumers from, risky money transmitters, basically, by licensing them. But in the statute, money is defined as the currency of a foreign nation or of the U.S. well, wait a minute, Bitcoin's not money according to that definition. Do we even have the statutory obligation to regulate these companies? So in some states, Bitcoin doesn't fit the definition of money, or a business like Coinbase that uses Bitcoin, even though Bitcoin fits the definition of money, doesn't fit that state's definition of money transmission. And regulators have to figure that out. Lawyers have to figure that out. And then there's beyond that even the question of whether you as a regulator are interested in dealing with this issue. And the bottom line is, as resource constrained as a lot of regulators are, especially at the state level, many of them just haven't wanted to deal with this question. So even if you're a Coinbase and you're a company that really wants to get regulated because you don't want someone knocking on your door at the middle of the night saying you were an unlicensed money transmitter and you're going to jail for 5 years, because, by the way, that's the criminal penalty for that. Even if you're trying to do the right thing, you're going to call up someone potentially in some state in middle America, and they're going to say, you do what with what? I don't know if you need a license. I'm not giving you a license. Maybe check in later. But in the meantime, we're not going to tell you you're safe. We're not going to tell you you don't need a license for this period where you're unlicensed. And that's not really, that doesn't give you a warm, fuzzy feeling as somebody who's building this technology or building a business, because that means that somebody could knock on your door in the middle of the night and say, actually, even though you called us and asked, you did need a license for the last 2 years where we didn't give you a license. And so you were in violation for those 2 years. And now we can seek penalties. So Coin Center's mission when it comes to consumer protection regulation here in the US, very specific issue, is twofold. It's to make sure that if you are a company that holds other people's money, that there is an easy path for you to get regulated. Because it makes sense that if you're holding other people's money, there should be consumer protection regulation. And that means either preempting state laws through an act of Congress, which is politically not viable right now, quite frankly. That's just a lot of political capital, because you'd be basically, doing something quite bold from the federal level and stepping on a lot of people's authority at the state level. Or it means getting all the states to sort of agree that this should be the common approach to licensing Bitcoin companies. But that means going state by state, educating them on the technology, analyzing their laws to see if the existing laws cover these activities. And then if they don't cover these activities, or if they cover them in a way that doesn't work, that would simply make it impossible for Coinbase to get licensed, but would still make them responsible for getting licensed, finding a way to amend those laws such that we can find a way forward. But that approach, as my colleague Jerry Brito likes to say, scale. And Coinbase, Coin Center rather, we try our best to go state by state and get in touch with any regulator who's turning to these issues. So, for example, in New York, Benjamin Lawsky at the Department of Financial Services turned to these issues right when we were getting started with the BIT license. And we actually didn't particularly like how the BIT license came out. We've done a lot better in some other states since then. No matter what, the approach doesn't scale. It's sort of reactive, and we'd have to get all 47 states and territories on board. So recently, we've been given a gift, actually, in this struggle from one of the oldest financial regulators in the U.S., the Office of the Comptroller of the Currency. The OCC is the federal agency that it's a branch of Treasury, actually. It's the federal regulator who charters national banks. So most of the big banks are nationally chartered banks, and the OCC is their consumer protection regulator, basically, alongside the Fed and the FDIC for insurance purposes. The OCC issued an innovation white paper last spring, basically, that said, hey, it was really quite frank and amazing. It said, hey, the U.S. is falling behind on FinTech, on financial technologies innovation. We're falling behind the U.K., we're falling behind Singapore, and we're partly to blame. The OCC is actually saying that they are part of the problem. So it was actually a mea culpa, and kind of surprising. It's not something you usually hear from a regulator, that sort of admission of fault. And they said, look, we're open to new suggestions as to how to improve U.S. competitiveness in financial technologies. And they said, one thing we're going to do is create a central office of innovation. And, we're not all that bullish on anything centralized, so hopefully that'll. But they also said, we're open to your suggestions as well. And so Coin Center, along with some other companies in the virtual currency space, and also some marketplace lenders who also have issues with state-by-state regulation, so like LendingTree and things like that, all of these groups got together and issued a bunch of different comments, most of them asking for a federal FinTech charter. So you as a company that builds some sort of innovative financial tool or service, and that would include someone like Coinbase who builds virtual currency tools and services, can apply potentially, and this is not yet the law, but hopefully will be, can apply for a charter from the OCC. And that charter is kind of like being a chartered bank, but it's more limited. So maybe you won't be able to take deposits in dollars because that's something we only want banks to do. And maybe you won't be able to do lending because that has to do with the dollar money supply. But what you could do is have access to the payment system so that I could ACH or send a payment message to Coinbase from my bank, and Coinbase could process it directly rather than having to go through a banking partner to process it. And the other thing you'd get from this is federal preemption of your state money transmission obligations because national banks don't need to worry about state laws. So it would be a way through the sort of wilderness of conflicting state laws if there was this vehicle. If Coinbase could say, we want to become an OCC chartered, nationally chartered FinTech firm, then they wouldn't have to worry about the 47 states and territories anymore. I've got another half of that if you've got a second. I know this is really long-winded. So the other half of this is, the other problem is that those 47 different states and territories that all have different definitions of money and of money transmission, some of those definitions are so broad that you could easily interpret them to cover a miner, a Bitcoin miner. In fact, you could probably interpret them as covering someone who just develops Bitcoin software or someone who runs a full node in their living room in order to relay transactions on the peer-to-peer network. And that means that even those parties potentially would need to get licensed. And that is a huge, heavy burden and a sort of gating or permissioning that we would not want to see happen because it would really stifle the development of these technologies. This is one of those laws that had an analog with the internet that would have potentially stifled the development of the internet. So how do we fix that? Notice the OCC charter option doesn't solve that person's problems because they don't hold other people's money. They do a non-custodial infrastructure type function on the Bitcoin network or the Ethereum network. They're not going to go apply to become a nationally chartered bank. That doesn't make sense for them. But they still have to worry about 47 states and territories and their various vaguely drafted laws. So for that, Coin Center has proposed, we sort of sketched or outlined a possible federal legislation that would be an act of Congress, but would be a smaller ask from Congress than asking them to fully preempt state-by-state money transmission. And what it would be is a safe harbor. So Congress would say something like, states play a vital role in consumer protection for money transmission. However, there are a set of activities wherein people provide infrastructure to these virtual currency networks. There are a set of activities that should never be or shall never be treated as money transmission by any state. And thereby, that federal law would create this safe harbor that would ensure that somebody who's just developing Bitcoin software or running a Bitcoin node on the peer-to-peer network never needs to worry about any one of the 47 states and territories that potentially could regulate them. That's also very important to us. I'll add, we are aiming to be advocates for the technology in general, not any particular company in the space. So we're more like the Electronic Frontier Foundation than, say, the Internet Association. We're an independent nonprofit who wants to facilitate the growth of the technology. And so this aspect of the money transmission problem is actually probably our top priority, is making sure that the people who are just, garage innovators, independent software developers, people running nodes in their living rooms, that those people never have to worry about money transmission regulation. It is harder to accomplish because we need an act of Congress, but it's definitely one of the biggest things that we feel we need to fight for.
Yeah. So, and where we are now in terms of where there's some gray area, and even if you're just a miner, you could potentially be in trouble. Are there any angles on that are opportunities rather than risks? Like, can I start a Bitcoin casino without risk, or is there some way I can evade taxes using Bitcoin where I'm potentially safe?
In the U.S.?
Yeah.
So, It's always going to come down to the specific laws that govern the specific activities. I'll tell you right now that gambling is one of the areas where you're really not safe. And gambling is actually really interesting, not just because I have some bad habits and end up losing money, but gambling is really interesting from a legal perspective because it's one of the chinks in the First Amendment armor that we actually have. To explain what I mean by that, generally someone who only designs software is pretty well protected by their First Amendment rights. So this goes back to a case called Bernstein versus the DOJ, I think. And this was an early test of how First Amendment protections applied to people who were writing cryptographic-oriented software, or really just software in general. So Bernstein was a cryptographer who was publishing cryptography standards, of course, and at that time, those cryptographic functions, that software was classified as basically weapons, and we have very strict rules governing when you can share information about weapons or share weapons with foreign states and such and such and such, and when you can publish these things. We have export control laws for weapons technology, and so when he was publishing these cryptographic standards, he was basically there was an attempt to censor him, to say you can't be open with that software because that's weapons and you're exporting it basically to our enemies potentially. And the EFF and a number of other important organizations, I think the ACLU probably as well, came to Bernstein's defense, basically, and said, look, he's publishing stuff you could write in a book. He could write the source code. He could write the machine code, in a book and publish that book. Are you saying you're going to ban the distribution or sale of that book? And it turned out that in that case, Bernstein won. And so this was a really important triumph in the early development of the laws that govern software design, is that you have free speech rights to the software that you design, not just to the political words you write on a paper, but also potentially to the mathematical formulas and the software you write on a piece of paper or onto the internet. Now, one area where this law doesn't hold up well is in gambling software. So there's another case whose case name has escaped me at the moment, where there was a company that was making bookie software. So it would help you keep track of bets on horses, for example. And so you'd open a shop and you'd have people come in and watch the horse races on television, and you'd keep a computer in the corner that would keep track of all the books for all the current bets of all the people in your gambling shop. And it would have other fun features, like if you press the right key combination, the screen would go blank or turn into solitaire. So, and the reason for that was if the cops burst in, you can hide evidence and maybe even automatically erase the books if that's something you're worried about from a law enforcement standpoint. Now, the developers of that software, even though all they did was develop the software, they didn't run the bookmaking shops. They weren't bookies. They got in trouble for interstate trafficking in gambling paraphernalia. And there was a free speech defense that was attempted in their case. They said, hey, all these guys are doing is writing software. And the court said something along the lines of, and this is not the Supreme Court, this only went up to the appellate level, I'm fairly certain. The court said something like, well, yeah, but the speech has merged with the illegal activity because their software can only be used really for illegal gambling. That is now illegal speech. And it's one of the few cases where a speech act and the development of software has not been given the kind of First Amendment protections we normally expect that act to get. And so this seems like a long digression, but the long and short of it is, if you were to write a smart contract on Ethereum that does gambling, and God knows there are probably a fair number of people writing that software right now.
They're prediction markets.
Yeah, or potentially a prediction market. You would not necessarily have robust First Amendment protections for your activities, and you might be very easily charged with interstate trafficking in gambling paraphernalia.
God, that is such a shame. I think that the stigma against gambling is so aggravating to me. It is so weird. It's so it is one of the great I hate to use this word here, but it's one of the great schizophrenias of our country. I think.
I mean, it goes back to a long history of what is considered, malum prohibitum or malum in se, or what is considered immoral, basically, and then that moral judgment is reified into law, and the standards around those tend to be really wishy-washy too. Like when does my software merge with something you think is morally wrong to the point where you can prohibit me from writing software? Pornography is another great case. What is pornography? What is obscenity? There's a great Supreme Court opinion where basically it comes down to we have no good standard for what is obscene, but I know it when I see it.
Right. Yeah, that's the classic. So how are big institutions like banks investing in blockchain technology? Is this something where it's like they are legitimately investing in it, or is it sort of like IBM with Watson, where they're like, hey, we got AI, and it's more of like a just for show type of thing?
So sometimes maybe the more charitable way of saying the just for show is we have blockchain as a strategy. Not necessarily we're adopting a blockchain technology for real use in any kind of application, but we've got a blockchain strategy. It really runs the gamut. So I think in some cases, these are big, older institutions that are simply worried about the so-called innovator's dilemma and don't want to be caught off guard. But the innovator's dilemma basically says that they will be caught off guard because their expertise lies in a field of endeavor that is completely different than where they're being disrupted.
So this is like the classic case.
Yeah.
This is the classic case of institutions trying to form fit the new technology to their pre-existing business model. Like when Windows, I heard recently that like the early versions of Windows Mobile was basically the Windows model where like they sold, like you had to buy the operating system to put on your phone.
Yeah.
And it's just like the classic case of like you try to form fit the or it's like, I hear this in terms of Apple, like they're trying to put the phone interface on the watch and it's just they're just trying to form fit the new technology against their pre-existing business model.
Right. But then there are also some companies that are being extraordinarily progressive, actually. So Santander, a major global bank, I believe out of Spain, recently announced a pilot program where they were going to put banknotes, so basically a certificate of deposit of a sort, on the Ethereum blockchain. That's probably the right approach, frankly. And they're going ahead with it, which is pretty awesome. I mean, it's going to take time to make things like that work, but we're not necessarily headed towards a future where the only currencies are cryptocurrencies. We could be headed towards a future where there are cryptocurrencies, and then there are still, fiat-denominated sums and balances that are issued by centralized organizations, but whose scarcity and movements are controlled because they're built on top of a decentralized computing system like Ethereum. So a smart bank would potentially be issuing currency of a sort, fiat currency, according to an open ledger or layered on top of an open ledger like Ethereum. That's very cool, and we'll see what happens there. And then the other big thing about banks and financial institutions playing with these technologies has to do with the architecture. So your listeners may have heard of R3CEV, for example, or there's a few other companies like them who are planning on building closed or private or permissioned blockchain or blockchain-like technologies that will facilitate interbank settlement or agreement between banks on contracts. And one of the interesting things about that is it in some ways, we can be pessimistic about it. We can say, oh, you just want to retain the same control you used to have. It's permissioned or closed, meaning that maybe it doesn't have public read-write capability, or maybe the read capability is public, but you can't write to the blockchain unless you're one of the pre-identified consortium members. You could say that could be, sort of just trying to hold on to their control. And in a cynical way, doomed to fail. But it's also kind of like the days of the early internet, when you had a lot of companies who were playing with TCP/IP and setting up their own private intranets, who eventually then connected to the global internet because they saw the value proposition, but weren't initially comfortable enough to jump fully in. So that's one of the general tropes that we're seeing emerge in how financial institutions are coming to this, is that they want a system that still has some level of control. They're not ready to go full open blockchain network and just play on Bitcoin. And some of that could even be regulatory, potentially. You're supposed to know your counterparties on a regulated financial network. And so if transactions are being mined by a miner in Iran, that makes you feel uneasy because you at bank are worried about talking to a regulator about why that just happened. Although I would say from a legal analysis standpoint, there aren't actually that many big impediments to banks using open networks right now, assuming they build some sort of sensible layer on top of it that only allows their customers to transact with, known entities or something like that. But maybe that takes all the value out of the network as well. Anyway, I've said a lot of things. I hope they're sensible.
Yeah, and we didn't even get into Ripple. So, yeah, well, I think this is a great place to stop. I enjoyed talking to you. I think people who are interested in this policy stuff around Bitcoin, this is going to be a evolving area, and I think Coin Center is a great repository for material. There are lots of white papers and articles on the Coin Center website, so go check it out if you are interested in this policy stuff. And thanks for coming on the show, Peter.
Yeah, thanks for having me. It was a lot of fun, Jeffrey.
Thanks to Symfano for sponsoring Software Engineering Daily. Symfano is a custom engineering shop where senior engineers tackle big tech challenges while learning from each other. Check it out at symfano.com/sedaily. That's symphono.com/sedaily. Thanks again, Symfano.
Wow.